Hello, everyone. This is Alan from Cruising Altitude joining you today, and I have a special guest, Ian Gray. Ian, welcome.
Thanks. It's great to be here. Great to meet you, get to know you a little bit, and hopefully make a good episode today.
For sure. So, full disclosure, Ian and I have never met before. We have exchanged a few DMs on Twitter, but other than that, this is it. And I think we wanted to kind of meet on air and get to know each other on air. So all of our cruisers, all of our followers can learn more about myself as well as Ian. And Ian, before I ask for you to share who you are and your background, part of my goal with Cruising Altitude and what Cruising Altitude is a investment newsletter focused on getting Gen Zers to be thinking long term. As you know, our age group likes instant gratification, day trading, all of that good stuff. But I think there's a lot of both money and life skills to be gained from being a long-term investor. And at Cruising Altitude, that is kind of our goal, to have individuals our age be thinking how to invest long-term. So that's kind of what we're doing. And if I may ask you to tell a little bit to everyone about yourself and who you are.
Yeah, for sure. So I'm currently a college student still. I'm going to the University of Loyola Marymount University. So I am going to be a senior in this upcoming year, but working on a finance degree and some, I think going to get a degree in economics and philosophy as well. So try and be a little well-rounded, which I think is important for investors, not just to get too focused on finance, but have some other things in life.
And then just to hop in real quick,
yeah,
some people struggle with getting one degree, and you're flexing that you got three.
Well, it's it's a double major, and then the philosophy is just a minor, so not a full philosophy degree, but it's that's something that's important to me and kind of runs throughout a lot of my the way I approach investing is from kind of a multidisciplinary, interdisciplinary approach, and really trying to understand, like, I really want to get to know the businesses when I'm investing. And so being able to have some of these different ways of thinking through problems, that's one of the great things about philosophy, I think. Now, this show is just going to turn into a pitch for a philosophy degree. But
this is exactly why we're doing this live, right? We'll see where this takes us. I love that.
Keep going. Exactly. But it just, there's a way, just approaching the world and just thinking about problems in different ways. I think sometimes in the finance industry, what we're all trying to do when we're investing in stocks is create alpha, right? And find that those places where we can get a little bit of an edge, generate some returns for ourselves. And sometimes, and I'm sure we'll get into some of the different ways we do that, but sometimes a great way you can do that is seeing the market in a different way than everyone else is seeing the market. And I think a lot of times that comes from some of the experience you have in the industry, that maybe you're a doctor, and so you have a little bit of an insight into some of the biotech space or something like that. But I think another way is just the different ways you think and approach problems. Sometimes you can see things a little differently if you have a philosophy background or a music background, or I'll dive into another piece of my background real quick. Last summer I interned with the Motley Fool.
Cool.
That's really where I kind of got my investing start, was reading Motley Fool articles and all this stuff we see all the time. And I decided, I listened to the podcast. The podcasts were a big influence on me, particularly David Gardner's Rule Breaker Investing podcast. I'd recommend that to anybody who's trying to get into investing. I think he does a great job of explaining the philosophy of long-term investing. And so went to the Motley Fool, and there they really believe in that approach. Like there's people there who have backgrounds in all sorts of stuff: environmental science, art history, some people from more traditional finance backgrounds, but all sorts of different backgrounds, and really trying to come at these businesses with a lot of different ideas. So that's a little bit about my background. That's kind of what I've done. What I'm currently doing is I'm getting ready to have an investment banking internship in this next summer, and potentially going into that industry after this. We'll see. I'm trying to figure out a little bit exactly where I want my life to go. But so I'm super interested in finance. I think investment banking is going to be interesting from the standpoint of seeing some of the more private transactions and not all the public companies that we see every single day. But that's kind of where I'm going forward. I have a blog I write. It's going to turn more into this is the first time I'm announcing this, but it's going to turn more into a essay site. It's called iangraylive.com. And that's just where I kind of share some thoughts, do a little bit of writing. And then I have a Substack called Optimist Investing. You can find it on my Twitter account. And that's where I share some kind of more thoughts about some of the investments that I'm making, a little bit about my portfolio, and then do some fun things from time to time.
You shared a lot of awesome stuff. I think one thing I forgot to mention when I was leading into this is I want Gen Zers, our age group, to see that there are really cool people our age investing long-term and totally above kind of the day trading noise. And maybe one day we'll reach out to anyone and everyone from Gen Z, but this was a very calculated offer, reaching out to Ian. You check out both of his websites, specifically. What was the name of your personal one? I am Ian Gray. I am
Ian Gray Live.
Ian Gray Live. Great.
Yep.
Awesome, unique, and really cool perspectives. I want to talk a little bit about more. I guess I should introduce myself too. That's kind of how introductions work, right? So I'm Alan, obviously from Cleveland, Ohio. Go to the University of Maryland, studying finance there. I'm a senior, probably taking another semester. And I love investing. I've been into it for a long time. My dad got me into it young, and I want to do something within the market as I continue going on. I guess forget what I was about to say. Do you think it's tough for a deep philosophy thinker like yourself to go into an IB job where they will likely, you'll work very tough hours? How does that kind of fit into your philosophy for life?
Yeah, so I would say I'm a little bit of a workaholic, always have lots of things going on. I think this will be interesting because instead of typically I've had lots of things going on and staying super busy, but at lots of different projects. I think when I go do that for a couple of months, it's going to be super busy, but with one thing, right? With just IB. And so I don't really know how it's going to go. I kind of think I'm going to like it. I think a lot of I like building models, and I like, PowerPoint to a certain extent. And I think I'm going to enjoy it, but that's part of the reason I tried to get this internship, was just to kind of give it a shot and see what it's all about.
100%. I think so many kids our age have this pressure. What are you doing now? What's your next 5-10 year plan? And all that's important, right? But there are internships for a reason, to see what you're kind of into and what you enjoy. So if I could ask you a little bit about your personal investing strategy or approach, how would you kind of define that?
Yep, that's a good question. So, like you, my dad got me into investing when I was pretty young, and I remember ordering a couple of 10Ks, getting them in the mail back, in the late 2000s, and he kind of always instilled that long-term. It's about the fundamentals of the company, right? It's about is this company going to make money for shareholders moving forward? And so that was always kind of in the back of my head. And I think basically on my 18th birthday, I opened up my own brokerage account, and I started off with some ETFs, mostly because it was through Schwab and commission-free ETFs. And so I was doing some commission-free ETFs, so I wasn't wasting my limited capital.
Thing, right? A lot of people think that it was always this way when they hop into the market now. But also I was just thinking that, we target Gen Zers, but there are older people that listen to this too. And they're probably laughing when we say, yeah, when I was young, we're 23 years old. But,
yeah, exactly. But yeah, so I kind of started off with some ETFs. Probably was a little bit I started trying to read, find that first year I was really searching for my investing philosophy. And I found the Motley Fool podcast during that first year, and like I said, I read the Motley Fool book and was really just impressed with, okay, I've got plenty of time in my life, hopefully. Let's set up a foundation for a long-term strategy here and for long-term success. And not start playing with my emotions too much on a day-to-day basis with the market. And so one of the things I did, I think the first company I ever bought was Walmart, first individual company. And it was kind of on the idea that, okay, this is a large business, but it's got some e-commerce potential. I do like the network of stores it has and all this type of stuff. And so I invested in that, and that was kind of, that marked my investing strategy for like the first 2.5 years that I was investing, was large companies with growth potential. So something like Walmart, something like Disney, Apple, Amazon, even General Motors, which has just recently started to actually pick up a little bit. But I invested in them thinking about the electric vehicle and autonomous vehicle revolution. And so that kind of marked, go ahead.
How long ago was this when you got started?
Yeah, so this was almost 5 years ago now.
Wow, great. So I hope you held on to those guys, because they really had a nice little run. But yeah, keep going.
Yeah, I did. I've had a pretty good run so far. It's been a good time in the market. But yeah, so then it was really marked by that. In the last, well, I'll say then about a year after that, I started getting interested in kind of some of that mid-cap stuff, things that were, a lot of software companies, a lot of things that were kind of on the rise that have been good over the last couple of years. Things like, even things like Paycom, Shopify comes to mind. I'm trying to think about some of the other ones that I invested in around that time. But anyways, those types of companies, or at least smaller large caps. And then the most recent kind of iteration, and I've held on to all those companies. I rarely sell anything. Like even GE was a total loser for me. I didn't believe in the vision of the company. I held on to it for probably 2 years too long because I don't sell. So I find.
Why don't you sell?
So one of the things that David Gardner talks about a lot is oftentimes we make these sell decisions and they don't, when you're making lots of sell decisions, that there's some of those that are actually going to pay off, and that the ones that pay off are actually going to be better than the ones that you sold that you shouldn't have sold are going to more than pay for the ones that you sold that you should have sold, if that makes sense. And so that you're just risking a lot of potential upside by selling. And so you want to be pretty, like, at times there are times to sell. And that's where the point I got to with GE was like, I just don't see where this business is going in the future. I don't understand it. And honestly, that's generally when I do sell. It's not just that that the business hasn't performed yet. It's that I don't feel like I understand the business well enough to know what's going to cause it to, like, why isn't it performing well, right? If I can answer that question, sometimes I'll hold on to it if I think that there's a chance that they turn it around. But with an example like GE, I didn't know what it would take to actually turn the company around. And with like Bank of America, I held for a little while, or for a couple of years, and finally sold this last March. I was looking at it and I was going, okay, they say when interest rates go up that the stock should do well, and then interest rates go up and the stock doesn't do well. And then when interest rates go down, the stock's going to do well. And so, and I'm like, I just don't understand the big bank. And so I'm going to sell it because I don't understand it. And I don't know what's going to cause it to do better. And it hasn't been a good performer. But you look at any of the great performing stocks over the last 25 years, and all of them, I think Microsoft is a great example. Microsoft was flat for 10 years. But if you had bought Microsoft back in 2001 and held it all the way to today, you would still be sitting on some pretty good returns. But there's a 10-year period where you basically got nothing. That's an extreme example, but even something like Netflix, right? Netflix drew down 80% at one point. And just that oftentimes these things take time to develop. We only get 4 quarterly reports a year. And so it's pretty slow moving, if that makes sense. It's not like you're getting all these points of feedback every single year. And so for things to turn around, or for things, if there's a spell of bad news, for good news to turn the company back around and start moving in the right direction, it actually takes a couple of quarters for things to catch up. There's a little bit of a lagging effect sometimes with the stock market. Oftentimes we talk about it being forward looking, but after there's been a lot of bad news, or there's been some bad results, it takes a little bit of time, in my experience at least. It takes some time. It takes a couple of quarters for it to kind of, for the stock price to start matching the business success again, because people are skeptical. And so, you know, there's just, I'd rather hold on to something for too long than for not long enough, if that makes sense.
Love that. And I also think it depends on the stocks that you're in, right? That if you're in these crazy micro cap type of stocks that have gone on crazy runs, trading at crazy multiples of sales, I think it might be a different conversation. But I love what you're saying about the big guys, right? That let them run. And I think the hardest thing for me I talk to my dad a lot about Apple, and I'm like, Dad, why do you hold on to Apple? It's a phenomenal company. I look at it, you look at all the fundamentals, brilliant. Every business school should be teaching that, right? But for me as an investor, it's kind of tough to keep your money there in Apple when there's smaller guys that could be making much bigger moves. So my question to you, how do you stay above the noise? How do you stay above the noise of the craziness of the market and that voice inside that's like, how can we figure out to make more money?
Yep, that's a good point. I think for me, the thing two things. One is the simple answer is if you can find ways to generate income, whether it's through a job or through other sources, that actually helps me a lot. When I have new capital to invest in the market, then I leave my existing positions alone. When I don't have that capital coming in, it's much more tempting to get out of something to buy something new, because I'm always looking for a new company. I own over 40 companies in my portfolio, and I think it's a constant conversation I have with myself. Should I slim down a little bit? Should I get it a little smaller? But so that's the first thing, is that the income. If you can find ways to generate income, it's actually easier to hold on to your existing positions. The second thing that I'd say is, for me, I do ask that question. I say, okay, what do I think about this company? And do I think it's going to continue to execute? Do I think it's going to continue to be a world-class company? With the example of Apple is a good one. For me, it's the second largest position in my portfolio. And a lot of that's, I've held it since 2018, and it's been, a 3.5 bagger for me or something like that, right? Which is kind of crazy thinking Apple, but you look over the historical returns of Apple and you think it just consistently does that. And it always surprises people. It always comes out with something new. And I'm like, I trust Tim Cook and the management team to continue to innovate, whether it's through, you always hear the rumors about what Apple's going to do, but whether it's in the healthcare space, whether it's in electric and autonomous vehicles, or whether it's in, I think, wearables and VR is an interesting space. And I really expect that Apple's going to come out with a compelling product in that space. And it probably won't be as big as the iPhone, right? It would be hard to say that something is going to take over the world like the iPhone did. But I still look at Apple and I see a lot of potential ahead. And if I can own a stake in the best, or a top 5 company in the world, I'm going to do that, right? That it generally works out for you, and you may not make the most money, but I think especially people our age oftentimes get sucked into, how do I make the most money today? And it's hard not to get sucked into that. And I think that there's ways to structure your portfolio where you are chasing some big returns today, but you can also set aside a little bit of money that is just with one of these long-term compounders that just does a good job of creating shareholder value over long periods of time. And it may not go up 100% in a year, but it's going to give you a good steady return for years to come, and you're not going to have to worry about it.
For sure. And it's so ironic in many ways that as our generation has really entered into the market, we've really kind of lost touch with what a stock is, right? I'm sure your dad, grandparents have an old stock certificate, right? This paper shows that you own a piece of this company. And as long as the company is a great company, trading at a fair valuation, like Apple, why would you not own it? Why would you ever sell it? And I think I feel myself getting smarter from this conversation, right? I think that it's cool to hear someone, I really try and stay long-term, but it's hard for me sometimes. which is totally cool. But I think hearing your perspectives is just awesome and kind of inspiring me to double down in many ways.
Well, and I'll say one last thing. That's nice of you to say. The other thing that kind of keeps me grounded is I'll throw into I've always got my, financial calculators around, and I'll throw in my financial calculator and see, okay, what does, what does $1,000 with, a 12% return for 40 years look like? And
yeah, what does it look like? Ballpark?
Let me plug it in real quick. I don't want to say the wrong number,
but you're plugging it in. Is that cool?
Yeah, go for it.
Great. So hopefully your professor is watching or isn't watching. So no pressure. But I think one thing I do want to ask you about as we continue our conversation is we talked a little bit before, NWK, right? That's a favorite company of yours that has a little bit more pop, a little bit more growth potential than some of the than maybe a company like Apple. I think I might actually be eating my words because you shouldn't be doubting an Apple. But then once we have the answer to our math equation, I do not give partial credit, by the way.
Okay.
Your thoughts on NWK and kind of what you see there.
Yep. So to give us the quick update on the financial calculator, $1,000 earning a 12% return over 40 years, you'll end up with $93,000.
That's crazy.
Just $1,000, right? And I would say, do I think Apple over the next 40 years is going to return 12% a year? That's a little bit aggressive, maybe, but historically they've done that at least. I don't know what it is, but they've done that at least for the last 20 years. So, that's 12% goes a long ways, and I think sometimes we forget that as especially as young people. It seems like a long ways out, and it is, but it's pretty big numbers that can occur. So to talk about Mohawk though, for me, I'm starting to increasingly look at small and micro caps, as I was mentioning, partly to get some of that pop in my portfolio, to kind of try and find those things that could really have a chance at being 10 baggers, 100 baggers, and really make that impact. I look at Mohawk and I see a simple business model. Basically, Mohawk is and this is Mohawk Group Holdings, as you mentioned, MWK. Sometimes it gets confused with another Mohawk, but MWK, Mohawk.
That what you're writing over there, a Mohawk? Is like,
oh no, that maybe I should. Yeah, I need to grow out the hair.
How cool would that have been if you just whipped out a Mohawk?
Out a Mohawk, yeah, that would probably be pretty surprising to a lot of people. But yeah, so basically, it's an Amazon third-party seller. So they manufacture and sell goods on Amazon, like an exercise bike, a dehumidifier, essential oils. They have all sorts of different products, and it's a little bit weird when you first start looking at it. But the thing that attracted me to it, honestly, the first time I looked at it, I thought it was boring. And I was like, I don't want to look at this. But then I looked at it a second time, and it was the simple business model that they're executing. And basically they say, we're going to launch a product. We can launch it faster than traditional companies because of kind of the technology they use and the relationships they have. And we're going to get it on Amazon real fast. We're going to spend a lot of marketing dollars to get people to buy it, and review it. And we're going to make a product for things that we know there's already a market for. So we're going to identify something on Amazon there's a lot of sales for, but maybe the reviews are low. And we're going to go in and see, okay, why are the reviews low? Is because people don't like the color, the extension cord is too long or too short. There's some feature that needs to be adjusted. They'll go make a better product, put it on Amazon, spend a lot of marketing dollars. And what they're really trying to do is get 4.3 stars or above on that product. If they do that, they say, we're going to rise to the top of the results. We can ramp down marketing spend, and then we're going to have a sustainable product on there that's selling and making us 18 to 20% margin on it. And so currently they're having about an 80% success rate with their launch products. And it's just a really simple, like I said, simple business model. Get the product up there, have it be successful. Only about a quarter of Amazon's searches, when someone searches for something on Amazon, only a quarter of the time do they use a brand name. And so Mohawk thinks they're filling this void of people really just looking for the best item for the most reviews, things like that. And that's how I use Amazon. And so it made sense to me. I'm looking for the top reviewed item. If it looks legit, I'll go ahead and buy that one. The other aspect of Mohawk's business model is now they're acquiring brands that have been built on Amazon that are doing 5, 10, $20 million in revenue on Amazon. And so they'll acquire those for about 3 to 5 times EBITDA. And then it gets incorporated into Mohawk, where it's at a sustainable rate of somewhere between 20 and 30 times EBITDA. And so they're able to create efficiencies and get multiple expansion immediately on these acquisitions that they're making. This year, they should do somewhere in the neighborhood between $350 to $500 million in revenue. And I know that's a large range because it's dependent on how many acquisitions they make, but they're trading at a fairly attractive multiple, in my opinion. And it's hard to see how you fail at this business model, given the scale that they've achieved and the headway they're making. And so for me, when I'm looking at microcaps, I'm often trying to find really predictable business models that have a clear pathway to success, because there are some more risks involved with the microcaps, just because there's more of a risk of insolvency and bankruptcy and things of that nature oftentimes. But you can limit that if you can find business models that you really understand, and you can see how the company can achieve that. Because it's hard to hold a microcap, right? Like Mohawk was up to like $49 a share. It's been down to $30 a share. They're pretty volatile. My biggest holding, Acuity Ads, lost half its value in like 2 weeks. But when you can understand the business model, you can sit back, and it's not fun to see your holding drop by 50%, but you can sit back and you can recognize, okay, this is a short-term thing as long as they execute. That's always the caveat. They have to execute. But if you can see through the short-term market volatility that's inherent with many of these micro and small caps, there's some opportunities, I think, to make some pretty good returns.
You usually, Mohawk sounds very cool. And I'd love to talk about that more, but every time there's a big stock dip, something like that, Mohawk goes from 49 to 30, Acuity gets cut in half. Are you always buying that? Are you always buying that dip, or yeah?
That's a good question. I don't always buy the dip. Oftentimes I do. I will say, like, rarely do I hit the actual bottom. Oftentimes I'll buy like halfway down or something, but it depends if it's a smaller piece of my portfolio or if it's a bigger piece of my portfolio. For something like Acuity that was a bigger piece of my portfolio, when it dropped a bunch, I pretty much stayed pat. I added just a tiny bit. When it's a smaller piece of my portfolio and I see a drop like that, and I'm confident in the business, I say, you know what, I'm going to go ahead and back up the truck, put some more in, because I'm willing to make that a bigger piece of my portfolio. When something's already at the top 1, 2, 3 position, I tend to try and focus on adding to things that are a little bit lower in my portfolio.
Cool. And in regards, I think one question I get a lot is like starting positions, right? How I really like a company. Are you putting in, I like to do like 60 to 70% of like what I would be willing to put in. Normally do 70%. If I was investing as well as I wanted to, I do 60%. But I want more of a bigger stake now. How do you kind of approach that?
It's a little bit on a case-by-case basis, depending on what the recent price has done. If the price has been running up a lot recently, I sometimes will invest more like a third, and I'll start with a third, and I'll say, you know what, if I don't invest before this, I'll come back a month from now and invest another third into this company, and then I'll invest another third a month after that. If it's a company that I feel like, something like Mohawk recently, I've been trying to build out a larger position in, and with the hit it took, I was like, I'm going to go ahead and push a lot of it to the table right now. So if the stock's been super hot, like I said, I am a little more methodical. And if it's taken a dip recently, then I'll be a little more aggressive.
Sweet. What's your investment timeline or horizon for a company like Mohawk?
Well, I'll say that when I invest in a company, generally I'm hoping that I'm never going to sell it, for all practical purposes. And when I say that, obviously once at certain points, I'll probably sell for like, personal expenses or buying a house or things like that. But that I'm hoping to invest in companies that I never feel the need to sell because it's reached its potential or something like that. And so for a company like Mohawk, I look at it and I think, okay, this is a company that could potentially be a 10 bagger for me, if not more. And I am investing in it because I generally like the management team, and I see a long-term horizon that I don't see the end of the road. You know what I'm saying? And
Yeah.
so basically, I'm hoping to invest until they give me a reason not to. So I know that's a little bit of a cop-out answer, but
No,
that's what I do.
that's phenomenal. I also think one thing that's really coming through is how well you get to know the companies, like a Mohawk, when you want to build a big position. And that's huge. If one of my favorite things to do, usually when I meet people in life and the stocks, is what's the vibe I get, right? That, yeah, sometimes that can be a little bit dangerous. That should be part of the bigger equation. But I started, I had a big position. I don't know why I said had a big position in Callaway Golf. I was following that for a while. Heard that they were buying out the rest of Top Golf. I was pissed because I ended up buying position. I thought the stock was going to be up to $45 a share. Total opposite. Went down to 15 because the street just wasn't happy with the price they paid. But as I looked into it, it was quite clear I was totally cool with the valuation of it. But what really gave myself confidence in the position was when I did a deep dive into Chit Brewer, their CEO. I looked at where was he before. He started off at Adams Golf. He was in the golf industry in the late 90s for a few years. And then he ultimately became the CEO there. And then when Callaway had all their problems, brought him in. And I saw how he rescued Callaway. That was really things weren't going well. And how they turned it around and stabilized it and ultimately started to acquire tangential businesses like a Travis Matthew, a Jack Wolfskin, an Ogio. These are more brand companies creating shareholder value. And then now Wall Street's doubting the same guy calling the shots about the Topgolf acquisition. And it's like Chip Brewer's leading the way. He knows what he's doing. And well, give some thoughts about management. For me, that's one of my most enjoyable parts of investing, learning the history of not only the company, but the managers behind it. And I really think that's a lost art.
Yeah, I agree with that. And I think you can also learn a lot. You can learn a lot from the history. And I think you just spoke on that really well. Totally agree with that. And you can also learn a lot from the way that they talk about stuff in the recent history, right? Go back and listen to the conference calls when you can, right? Go back and read the conference calls. How are they talking about things? Are they meeting issues head on? If you know the company well, you're going to know what the big issues are. And if they go, it frustrates me sometimes in conference calls when I'm reading through the transcript or listening to it, and management isn't answering the big questions, right? They're kind of trying to avoid it. They're trying to pretend like the big question isn't really a big question or things like that. I really enjoy owning the companies that management says, yeah, this is the big problem here. We've got a big issue here, and this is how we're going to go solve it. That just gives me a lot of confidence that they actually are thinking about the right things, that they're not scared of the issues. They're not trying to hide anything from me. They know I'm not stupid, right? They know investors know what the issues are, and they're going to go execute on it. And so that's been a big thing for me. And one more comment I'll make that something you said kind of reminded me of. It's often, and I think the management piece of it's like important when there's an acquisition, that you see how you can see through kind of the storm clouds of today. But one of the reasons that I think there are so many of those negative sentiments in the short term is you see a lot of these Wall Street analysts are looking for 1-year price targets. They're looking for, do I rotate into this, out of that? And I'm not going to bash them. Like that serves a purpose, right? But especially as members of Gen Z, we have long time horizons, or at least we should have long time horizons. And that's one of our biggest advantages, is we don't have to get in and out if this thing is going to be flat for a year and a half, right? That's okay if it's flat for a year and a half, if it means we're going to get to be part of, a 5-bagger after that for the next 10 years. And so, another good example, like Teladoc was one of my big positions. Right. And when they acquired Livongo, the stock tanked. And I was like, what is going on here? Like, they just acquired a company that everybody loves. It clearly fits in with their business, but people are focused on the short-term future where there's going to be some higher costs and things like that. And I don't even know if that's true, but I think people oftentimes just get, that's one of the things that knowing management or knowing a lot about the business is you can see through some of those short-term news headlines, right? You can kind of get the grasp on how does this fit into the overarching strategy, and having a good management team like you're discussing just makes such a big impact and gives you a lot more comfort that they're going to be able to have a long-term strategic vision.
For sure. Now, I look at a couple more things about Callaway Golf, like you were saying. I was talking to one of my friends, my roommate. We have fascinating, he's new to the investing world, and we have a lot of fascinating conversations. And he was telling me, Callaway Golf's at 30, it's not going to go much higher. And I'm like, in the short run, you're probably right. But that's when they make it clear, front and center, that they see $1 billion of adjusted EBITDA opportunity in front of them. I've checked into the golf industry pretty deep. 10 to 12 times EBITDA is really, really normal. So let's think $1 billion times 10 billion. Right now, it's about a $4 billion company. That's 2.5 times upside. And all I have to do is sit on my fingers. And I think as an investor, you should want to find opportunities where your biggest doubt about it will be if I'll be able to control myself of not doing anything to the position. And there are just so many opportunities out there. And I think it's so important, as you've been mentioning, always be thinking long term.
Yep. And just to make one last point on what you were saying right there, I think that's what I call back of the napkin math, right? You just do a little, anybody can do that on a whiteboard, right? They're saying $1 billion in EBITDA. Do we believe them or do we not believe them? Doing a little bit of research on what these companies are typically valued at, and you can get to a number, right? And it doesn't give you exactly what date they're going to get there. It doesn't give you exactly what all the other stuff that's going to get there, but it gets us in the ballpark, right? You're able to say this, if things go well, this is a 2.5x or so, right? And that just really helps you sit through. I've done similar math for Mohawk, and that helps you sit through when it goes from 49 to 30. It lets me go, great, I get an opportunity to accumulate more shares than I would have because I like where this is going. And unless they give me a reason to think they're not actually going to meet their goal, then I'm happy buying at a cheaper price.
Love that. So we have a few minutes left. Do you have a question for me? I've got much more for you, but
I'd love to turn the tables a little bit. Yeah. So I'd love to just hear about, I think it's so important to let people know about, Gen Zers know about investing and all of those types of things. I think I think our generation is prime candidates for investing. I think there's a lot of characteristics of us that will make us good investors. What do you think, and with some of the work that you're doing, what do you think is the most important lessons that new investors our age can kind of take and implement into their lives to really become, whether it's better investors in the stock market or even just better investors in their lives?
There you go, Mr. Philosophy. I love it. And it's something I think about a lot, right? You need to be a good long-term investor. Process is a integral part of that, right? That to do it right, you should do due diligence, not sprint into a big position in a company, and be ready for the ups and the downs and allow your values to kind of guide you through the downs and allow you to keep perspective up in the highs, right? And I think you could replace the word investing with life, right? Everything, I think, of course, in our younger years, we've been told, and you can see it firsthand, that when you trust a process, don't trust it too hard, like the Philadelphia 76ers. I don't know if I see some basketballs behind you, but I'm not into what the Sixers did. I think a team of athletes is a breathing. They're humans. This isn't a business. You can't tell a fan base. You can't tell people wait 5 years. It's tough on the spirit, but don't go too extreme with your process. But back to life is when you are pretty disciplined and aren't rushing through things and needing to see immediate results, whether it is in a relationship, school, anything really. I think you will be a much better investor, but also a much happier life. And yeah.
That's good. That's good.
And I don't study philosophy, but I'm a pretty deep kid too.
Yeah, no, I can tell. I can tell. It's been a good conversation so far.
Yeah. Did you want to wrap it up?
Sure, we can maybe. I honestly don't know a whole lot about what you're doing, so maybe if we can
Yeah,
wrap up, give a little bit of a sales pitch about what you're doing, and yeah, just kind of let anybody else know who's maybe listening for the first time what's all going on at Altitude.
for sure. So, and then I'll flip it to you. You already mentioned some stuff, but so the way Cruising Altitude's in the first inning, right? We are 4 months young. We have 580 subscribers to our free weekly newsletter. What is in our free weekly newsletter? We're going to go through. We have a casual tweet of the week that simply is just funny because investing should be fun, and it usually doesn't have much to do with the with stocks or anything like that. And then we have a spotlight piece where every week we will have original, long-term driven, focused stock analysis. Tomorrow we're writing or when this comes out, it'll be a couple of days ago, about a company called Brainsway. A lot of times we talk about, I'll get to that in a minute, but we're writing about a company called Brainsway, where they have $140 million market cap. They're a medical device company. And we kind of are very transparent about our thought process. How do you analyze? You're really trying to teach that analytical lens. And what are we looking at from a very brief, high level financial perspective, more back of the napkin type of thing? Who are their competitors? Where are the growth? And then a lot of times we have a portfolio of stocks too. There are currently 9 stocks in our portfolio. Sometimes they're candidates to be in them. Brainsway was a candidate, didn't make the cut. We talk about that's okay that it didn't make the cut. It's okay to have a watch list of stocks to keep an eye on. I like companies that are profitable, and a lot of growing companies are not. So I don't want to betray paying a high multiple for their sales, but we have a portfolio of stocks that is often the highlight, that is often the spotlight piece. So you'll read a lot about Viacom CBS, Callaway Golf, Penn National Gaming. We've done a piece on Teledoc, and there's a few more. And then after that, we go through, we have an educational piece, pretty general education. We have portfolio trivia, where we ask trivia companies on our trivia questions on our portfolio picks, because we want people to kind of learn about these stocks more passively. And then we have investment FinTwit tweets of the week, portfolio news to stay updated on our portfolio picks. And that is the newsletter. And then now we are getting into a little bit of podcasting. And this is something that I want to do more of, trying to find younger investors that I think can be phenomenal role models for people our age trying to get into investing. We're not saying buy this service for $50, $100. No, this isn't that complicated. Do your research, allow time to be on your side, and things will work out pretty well.
Yeah, sounds awesome. I'm excited to kind of see where it goes, and definitely going to be following you guys for the foreseeable future. I'm excited. I think I think what you're doing is just such great work, because like I was saying, I think Gen Z is so primed to be great investors, and there's a lot of people out there who I think are feeding Gen Z the wrong information about what investing is and what the stock market is all about. So it's great to have people like you really trying to flip the narrative.
Thank you. And I think just one last thing with our number one lead stock at Cruising Altitude has been Viacom CBS, right? And how did I uncover that with my team to add that to the portfolio? Because we didn't take things at face value, and we thought through things through our own lens. And I think that's a big characteristic of Gen Z and youth in general, right? But if we're in this game, I wish I didn't say that, because it doesn't have to be a game, but we're in this game really young. And if we bring that youthful spirit, understand we don't know everything or even close to a lot, but find our niche where we could really carve our investing path and what we know, I think we can do really big things.
Yeah, and just have that natural curiosity, right? Just ask questions, right? I think that's one of the biggest things for being an investor, right? Being a good investor means asking lots of questions and looking for the answers wherever they lead. And I think what you said about, sometimes things don't actually make the portfolio. It's okay to do some research and let something go to the side, right? That's not a mark of being a bad investor. That's a mark of being a good investor. So asking lots of questions, doing lots of research, reading lots of resources, it's all great stuff. And especially as a young investor, just getting your hands on as much as you can. That's been so integral into my life, whether it's podcasts, reading articles, financials, 10Ks, whatever, you name it, right? Just reading as much as you can. It's a little bit like drinking from the fire hose, but it pays off in the long run.
Ian, this was a blast. Thank you. I hope we can do this again sometime. And we'll attach all your socials to the video and things like that. And this was great. Have a great evening.
Yeah, sounds great. You too.
Awesome.
Thanks for having me.